Hi, folks. This is Mike Zlotnik, Big Mike, and today's discussion is all about the best risk-adjusted return opportunities in real estate in today's environment. But before we do that, the usual disclaimer, this is for informational, educational purposes only. No advice of any kind, no solicitation of any kind. If you're interested in any of our funds or syndications, request PPM, private placement memorandum, to accredited investors only. Consult with your attorney and CPA professional if you make any investment decisions. So let's talk about the best risk-adjusted return opportunities in this market. We're recording this in early November 2023. The market is changing, of course. So let's talk about the safest investments first, and then we will jump into what are the better options. So safest investments today are U.S. Treasuries. You can park cash and fairly safely make 5.5% in short duration Treasuries, take no risk. Is that wrong? Absolutely not. That's a great way to park cash. Certainly a part in anyone's portfolio, but is that all you can make in today's environment on a risk-adjusted basis? That's the key question, especially if you're income focused. So investments in equity have become less attractive because the interest rates have gone up. So returns on equities look like they've come down while returns on debt have gone up because you can get a high yield on loans. This is basic common sense. So again, let's look at equity. So equity could be attractive if you buy very, very deep. You have to get into a phenomenal deal from a very distressed seller, whether they're pressured by variable rate mortgage that they have or underperforming the asset, but they have to be distressed. And that's when you can come in as a buyer and get a great deal. And that can make sense because you're getting such a great price and you can actually deal with the high interest rates. Now that aside, equity has a lot of risk. How do you get sort of in between super safe investments and equity risky investments? Is there anything in between? And absolutely there is. What this has market created opportunities in mezzanine debt. So mezzanine debt is the debt between typically primary debt and equity. It lives in between, carries less risk than equity and more risk than primary debt. So being in mezz debt, you are sort of in between. You're taking a measured level of risk. So give you an example. So you can have a deal, $100 million property for sake of simplicity. And primary debt would be 65 million, and a secondary debt or mezz debt could be 7 million. So if you combine the first plus the second or the mezz debt, total is 72 million on a $100 million total value. That's 72% loan to value ratio. And you can get very high yields in mezz debt. In today's environment, in mezz debt, many deals offer returns somewhere on the lower end of the spectrum in the mid-teens, and on the high end of the spectrum is high teens, all the way to 20%. In that range, 15 to 20% return. Of course, deals vary. And what's most important thing is not looking at the deal in bright and shiny objects. What is the most important is that looking at who is the borrower, who is the sponsor, who is the operator, who are you investing with? And then you look at the project. What kind of project? What risk level on the project? Because the project gone through value add phase. Is it stabilized? It just needs to refi and hold the property through leases cycling up, getting higher rents through continuous improvements in the rolling leases. Or the project needs a lot of work and there's a lot of risk associated with that. So it depends, but you have to understand the project, who you're investing with, obviously, first, and the value add strategy, the business plan, and the opportunity to get yields in the high teens with very well understood level of risk with large equity cushion behind the mezz debt. So it provides a phenomenal risk-adjusted return opportunity if you participate in the right projects. And again, this is as a strategy. Of course, every project is different. Location, operator, type of property, so on and so forth. But as a general strategy, where do you get high yield and you take measured and well understood risk, mezz debt comes in. And by the way, when it's 18% or 16% or 17%, some of it could be current pay, some of it could be deferred, because it will be difficult for the owner of the property to service the debt at 18%. But if you're servicing the debt at 10 and you're accruing another 8, it's very manageable. And many projects can exit in 18 months, 24 months. Right now is not ideal time to exit. So sellers don't actually want to sell the property because the market is very soft right now. But in 18 months, 2 years, the opportunities to sell will come back. So it becomes a very attractive proposition for the owners to actually borrow mezz debt and for investors to participate in mezz debt, providing that capital to the owners at the very attractive risk-adjusted return interest rates. So there's no right or wrong investment. It all depends on it for individual. So let's talk a little bit about mezz debt and what quadrant it falls into, because the quadrants methodology is one of the best way to understand how much risk reward you're focused and whether you're looking for income or growth. I developed it a number of years ago. We continue to use it. So mezz debt, solidly, most of these deals fall into quadrant 3. Now, quadrant 3 are speculative grade quadrants. If you remember, quadrant 1 and 2 are investment grade, and quadrant 3 and 4 speculative grade. There's more risk in quadrant 3 than quadrant 1, no question about it. But you get compensated with the appropriate higher level of return. For some folks, they just want to stay with the majority of their money in quadrant 1 and 2 and be happy there. There's nothing wrong with that. But if folks are looking for a little bit more yield or a lot more yield, and they're willing to take on well understood risk, quadrant 3 may be a phenomenal opportunity. Now, quadrant 4 has growth, and most of the equity and speculative deals live in quadrant 4. So quadrant 4 is what most people want to avoid in this environment. But quadrant 3 becomes very attractive, even though it's still speculative. So different strokes for different folks. Of course, consult with your attorney, CPA professional. Make sure mezz debt deals make good sense for you. And just tell you what our funds are doing. We absolutely love quadrant 3 deals. Today's environment, many of our funds that are income focused, such as Tempo Income Fund, are participating in these type of deals. Why? Because this is where we can pick up strong yield, understand the level of risk, and be very, very comfortable. And that enhances the returns in the fund like Tempo Income Fund that does invest in primary debt. So primary debt can be a foundation. You can get good yields there, but you can enhance those yields by participating in quadrant 3, mezz debt type of deals. And once again, it's not about the general thesis. It's all about specific people you're investing with, specific deals, specific opportunities. Property diligence has to be done on deal-by-deal level. So I just want to make sure, at least from an educational perspective, you have this perception that you can get pretty good yield. And again, nothing wrong with keeping some portion of investment portfolio in treasuries, some portion in primary debt, some portion in mezzanine debt, and some portion perhaps in equity, taking some more risk if the deals are such that you're buying deep enough or you're partnering with somebody who's buying deep enough. So I appreciate your time and attention. I hope this was helpful. Please reach out if you have interest in upcoming deals. We have actually mezz debt deals today, and we have upcoming deals as part of our platforms, as well as the Tempo Income Fund is participating and Tempo Opportunity Fund is participating in mezz debt and primary debt opportunities. Please reach out. Speak with us. We're happy to answer any questions. Appreciate you. Have a wonderful day. Thank you so much.